Yeah. So Deepak, I hope the screen is visible.
Yeah, it's visible.
Yes,
Yeah.
it's visible. Yes.
Yeah. So while our topic today is smart investing, and as you can see, the presentation is saying simple investing. So smart investing is nothing but simple investing principles plus the right behavior. So irrespective of the situations, the investing rules are actually very simple. The variable factors are behavior and response to those situations, and that's what we'll cover today. So hence, simple investing plus right behavior is actually smart investing. So here's what I'm gonna sort of present today. There are, as you can see, I've been told by CII that it's going to be a very mixed audience, from some youngsters to people who are coming at the age of retirement, from salaried individuals to some business person. So I'm going to make it very generic so that the rules are applicable to everybody. So as you can see, what does the first investing rule say? That you should diversify and rebalance, right? The pertinent question to then do the execution is, oh, so I am an investor and where should I invest? Is it equities? Is it debt? And is it gold? So we'll try to answer these questions through the presentation. The second investing rule is, you can see, invest with good quality fund managers all across cycles. Now, the question is, and when we do this discussion, there's always this, okay, should I invest only in the best performing funds? And we'll see how relevant it is to invest into the best performing funds. The third is, invest time in the market. And in particular situations like this, we keep thinking, how do I try and time my entry and exit to optimize my returns? And the last is, it's a very simple thing that everybody knows, that you have to buy low and sell high. But then, should I be exiting when the funds are underperforming, which is, the case in point today? So the underlying principle amongst all four of them is investment decisions are mainly driven by, how we think and how we behave. So behavioral bias comes in a big way in each of these principles, and therefore I will have the most exciting, the last part of the discussion on behavioral, in the later part of the presentation. But as a background to what we are discussing, I just wanted to take one slide before we actually get into the presentation. So you've been hearing about corporate earnings and balance sheets of various corporates. Since most of us on this webinar today are all individuals, think individually of our own balance sheets and what is happening across our environment to see how pertinent it is to do this financial planning today, right? So I am just taken a 7-year time period, let's say between 2013 and 2020, and I'm saying that if each one of us are as a balance sheet, what is happening is the real private consumption expenditure, right, by individuals has grown at an average of 7%. However, the real personal disposable income has posted a growth of only 5.5%. So, you heard about this Amdani Athani Kharcha Rupaya. So where is this gap then getting filled with, right? And if you see these graphs, it is very clearly seeing that this gap, private consumption has consistently grown faster than disposable income since 2013, and which is clearly led by a combination of higher household debt and lower household savings. So what we are doing is we are borrowing more than what our incomes are, and we are saving less. And these two factors are actually funding the entire consumer growth. And this eventually has also led a lot to how our GDP has grown over the last 7 years. Now, because of COVID, the drastic change which is going to happen is that there is going to be a stressful income growth, whether it is to do with salaried income or to do with business income. and it's going to change the behavior to be more conservative and lead to buildup of savings, right? Secondly, all of us are going to borrow less, and the ones who are lending, the banks, the NBFCs, and so on and so forth, they're also going to be very cautious of whom they want to lend. Now, both of these factors together will bring down the household debt and naturally increase the household savings. Obviously, when you do this, it is going to impact, on the consumption and, probably a muted GDP growth for the next few years. And in this context is what then you should relook at it, that if the household savings is going to grow, then where should one invest in? What is it that one should do to avoid some of the, traps of investing, which, all of us have learned over the last many years. So let's explore what does not work and more importantly, what works for all of us, right? Yeah. So coming back to the first thing, this is a very important graph for all of us, to relook at it. We've taken data all the way from 1993, and going all the way up to 2019, and we say if we take the four asset classes, right, which is equity, gold, debt, and cash, and if you look at it, which asset class actually works well, and as you can see, every single year the winner keeps changing. So 93, 94 it was equity, then 95 it became gold, and 1996 it became debt, right? If you look at the second rank also has consistently changed, and that is true for not only the 4-year block of 93 to 96, it is true for 2000 to 2003, where two times the winner was debt, followed by cash, then by gold and debt, and then equity. Again, the winners keep changing between 2008 to 2009. You have equity, and then you have gold, followed by equity in 2009. And so is the trend in 2016 to 2019. So the point is, at any point of time or any part of the year, you are not going to have the same asset class which is done, always consistently better than the asset class. So the winners keep changing. So now, this whole topic of asset allocation. So how relevant is asset allocation at different points of time is what I just want to demonstrate. Hypothetically, since it's a very mixed lot of people, what I have done is very simplistically, let's say we create a hypothetical portfolio where 25% is invested into each asset class. Let's say into 25% to equity, debt, cash, and gold each. And then let's look over the last so many years, since 1990, which asset class has done well and what returns the portfolio has given. So as you can see, in the first 3 years, the portfolio returns have been actually second to equity. Then it goes down because equity continues to do well and the portfolio returns has come down. And as you can see, most of the times, right, and not only in this period also, the portfolio in most of the times is actually either ranked number 2 or ranked number 3. However, most asset classes, they can, vary between number 1 to number 4 at any point of time. Now, which asset class will do better in which period of time is obviously, difficult to portray. But if you look at it over the last so many years, so 2005 to 2007, it was equities, then it was gold, followed again by equity. 2010, 2011, it was gold. And then again, so it keeps moving between equity, debt, cash. But if your portfolio, if you look at it, is normally a, second or the third ranking. So what it does is basically, if you look at the table below and, look at the table below and returns of the asset classes, you will see that the portfolio returns for the last, if you look at from CAGR, actually from 1990 to 2020 over a longer period of time, equity is given 13.6%, debt has given 8.6, cash is actually 7.3, and gold is 10%. So your portfolio, which is a mix of, equal allocation across the four, has given you 11.1%, which is actually ranked second. And by taking much lower risk at 8.8% vis-a-vis, let's say, equity, which is taken a risk, which we normally call it as standard deviation at 28.3%. And the right hand table will tell you also how the returns have moved over the last 1 year, 3 year, 5 year, 7 year, 10 year period on a monthly rolling basis. So the portfolio average returns, have been anywhere around 10.5 to 10.7% across the 10-year period. And the gyrations between minimum and maximum will keep changing, right? But you will see that 3 year onwards, there has been 100% positive observation, which means that if you had a mix of all these in the same asset classes, if your holding period is more than 3 years, 100% of the times the returns have been positive, which means you didn't had a single year where the returns were negative with this combination. So what basically asset allocation does is it is trying to minimize your risk and optimize your returns. So it may happen that a certain asset class in a particular year can actually give you more returns, but the risk which you're taking to do that is much more than if you were to follow an asset allocation. Now, the simple question which everybody may have in their mind is, okay, so if asset allocation is the solution, what is the right asset allocation for me? So clearly, there is no right answer of what should be the ideal asset allocation, because there is no common solution to everyone, because each one's needs are different, the expectations are different. 12% is a good return for somebody, 12% is not, is a very conservative return for somebody else. And hence, there is a process, a very scientific way to identify for every individual what is the right asset allocation to him, right? And it is a factor of what is the time horizon one is looking, what is the risk appetite the individual has, what is the investment objective one has in mind. Is it to do for buying a home 10 years later? Is it to do with buying a car 3 years later? Is it to plan something for retirement, or somebody's daughter's or son's marriage? So the investment objective will change, and what sort of a target return one is looking. Like I said, for somebody 10% is a great return, for somebody else 10% is not a great return. So once you do there is a process to follow, and once you get all your needs into consideration, your financial advisors can help you to identify what is the right asset allocation for everyone. Once you do the asset allocation, then obviously, point comes of which are the right funds, where should invest, and so on and so forth. But the starting point, like I said, is, getting the asset allocation right. And like I said, for some aggressive investors, it could be, let's say, 90% equity and 10% debt. Or for a very conservative investor, it could be the other way around, that it would be probably only 10% in equity and 90% in debt. So that is, followed by the asset allocation strategy. And that, I think, answers some of the questions on, and we can have individual views of which asset class works well. That's a separate market discussion. Coming to the second point, so okay, you've done your asset allocation. Your asset allocation says that, okay, 30% debt, 70% equity, and within that debt you can then mix between, let's say, gold and cash. But then one of the common myths people have is that, does buying the best performing fund the right strategy? And how do you determine the best performing fund? Is it's a rear view mirror psychology. You look at the data, you say, okay, this fund has done well in the last 1 year, 3 years, and I want to invest in this fund. This chart actually is a comparison of the ranks based on consecutive 3 years of any fund's performance. So let's say in the period of 2009 to 2011, the 3 year period, the number one quartile fund became 167th rank in the subsequent 3 years from 2012 to 2014, right? And if you look at these 3 year blocks, all the way the vertical columns which are there, if you look at the last two columns of 2014 to 16 and 2017 to 19, the funds which were ranked number one, let's say between 2014 to 2016, became 230th in a universe of 238 schemes. And that is not true if you look at all the top four funds across time universe. None of them actually figure in the top 10 also in the subsequent 3 years, right? Except one fund in 2012-14, which was ranked fourth and became first in 2015. That's one anecdotal example. So what is happening here? The winners, like the way we saw in asset classes, keeps revolving. The best performing funds may not remain the best performing funds in the subsequent 2 to 3 years, right? And obviously, for the ease of, we have excluded the ETFs and the index funds from this, so that these are all actively managed funds. Now, why does this happen? This happens primarily because, and this is, I'm just taking an equity exposure, so that the reason why this happens is because smart money keeps moving from one sector to another sector, depending on the regulatory environment change, the headwinds and the tailwinds in the macro environment, the global situation keeps changing, the international trade keeps changing, and so on and so forth. So there are many dynamic factors which makes somebody responsible to go ahead and say, okay, I want to invest in X fund. There are FIIs who decide a view, whether it is an emerging market or a developed market, and so on and so forth. So then it is not the right thing to just go back and see, okay, in the last 3 to 5 years, this fund has been the best performing fund and let me invest into this, right? So that's one myth. We should definitely take it away. And this is another chart depicting the same thing which I spoke, that if I were to look at the period, investing in the top performing fund based on 1 year, 3 year quartile. Now, I'm not taking a particular fund. If you look at the top quartile funds, 25%, the funds which were in the top quartile, look at what is happening, right? The rank after 1 year, out of the 25% of the funds, only 36% of them remain in quartile one, and 20% of them actually go down to quartile four. Now, if I were to invest in the top funds again, basis 1 year performance, and see how do they rank after 3 years, nothing has changed. It's the same, 33% in quartile one and 17% in quartile four. But what if I take instead of 1 year a 3 year performance and then again invest and look at it 3 years later? It's the same thing. So history suggests that only one third of the funds remain top performers in the near term, right? So as the cycles keep changing, the winners keep changing, and therefore a rear view winner definitely does not work all the time. So this very clearly says, so what would you prefer? Would you prefer a short-term performance driven by luck, or long term wealth creation driven by skills? And this is just one of the examples. 37.4% is what the Nifty 50 outperform on a 1 year basis, if you have to look at all the way from, let's say, 2003 to 2020. And just for comparison, I've included one of our value PMSs, which is at 62% of the time it is outperformed. And there are some more examples just to share with you. Let's say if you take even a HDC equity fund, which has a very long track record. So now look at it. INR 10 invested way back in 2002 would have become INR 285, and investment in pure index fund, because I saw some questions that is active fund management better or one should stick to index funds, right? If you were to invest in this particular example in a Nifty index fund over the last so many years between 2002 to, let's say, April of 2019, since the data is available there, the CAGR was about 13.2% for Nifty, and for HDFC equity fund it was 20.6%. Now this is a delta which normally an active fund manager does, but as you can see, there are vibrations and volatility which the fund has gone. So the learning is that never look at 1 year, 3 year performance, look at longer term performance and see how it shapes up. Now, how does one choose which fund to invest? Right? This is a bit of a proprietary manager selection framework which we adopt in Motilal Oswal Private Wealth Management. This is done by our in-house research team. They've created a 4C framework. So instead of choosing which are the best performing funds, we choose who are the best managers, right? And there is a framework for equity fund manager and there is a framework for debt manager. Now, this I'm not going to spend much time because this basically means that you have to look at some four C's which we created, which basically is the fund manager having a clear approach and styling in investing? Does he remain true to the mandate? Which means if he is, let's say, a growth style investor or a value style investor, then he does he stick to that style? What is the consistency of returns over a longer period of time rather than just considering a smaller point to point returns? And in spite of the markets going haywire and swaying, does he consistently stick to his philosophy, what the fund mandates him? And capability of the manager and the team over a longer period of time in terms of how they handle different crisis situations, and more importantly the credibility and the integrity of the fund house itself, right? And many fund managers have many years of experience, so they have seen multiple cycles. So do they have any high conviction calls in this? So this is more of a internal analysis which we do, and we choose then the winning managers. And once we choose the winning managers, then we drill down to see, okay, which are the schemes of those winning managers we should look at it. So that was just to highlight how do we what is the importance of investing with good quality fund managers across market cycles. And the third and the most important thing which everybody thinks is, okay, is this a great time to invest or is it a great time to exit? Because how do I time the market? I think investing is a bit like this. It's a play of luck or a skill. So if I were to just put it in a matrix, at one end of the extreme is a pure luck. If you go to a casino and play roulette, it's a pure luck. There is no skill there. At the other end of the spectrum is, if you happen to know how to play chess, right? You know what I'm saying, that there is hardly any luck in chess. It is a pure skill game. So where does now investing fall? Investing actually is somewhere midway, right? It's a bit of a luck and there is skill. Now what is in your control? Like I said, and we'll come to the behavioral part, but as aptly quoted by Michael Mobusin, when a measure of luck is involved, a good process will have a good outcome, but only over a period of time. And like I keep saying, that if you were to look at investment universe and a horizon of more than a longer term horizon, for depending on which asset class one is investing, a good process of manager selection and a good process of asset allocation and a good process of sticking to your investments is, the probability of yield is much higher, right? The luck part, a lot of it is to do with how we react and how we behave to various situations, and I'll come to that. So, and this is again a very interesting graph just to make a point that it is so difficult to time the market, right? And if you look at this graph, which is a performance of Nifty 500 companies from January 2003 to April 30th of this year, and assume that let's say about a 1 crore was invested in Jan 2003. If you were to be fully invested in this portfolio over this period of time, you would have got, let's say, 14.4% annualized returns. Your 1 crore today would have been become 10.35 crores. Now, in this so long a period of, from 2003, 17 years, if you were to just miss one good month to invest, your returns would have fallen from 14.5 to 12.5, and your corpus instead of 10.35 would have been 7.7. And as you can see, it keeps going down every time you miss the best number of months. So let's say the last graph, if you miss the best 5 months to invest, your returns actually have come down from 14.4% to 8.5%. Just 5 months out of the 17 years you missed out, and your returns have gone drastically crashing to 8.5, and your corpus from 1 crore is now become only 4 crores. So it is quadrupled over the last 17 years vis-a-vis a fully invested portfolio, which has become 10 crores. Now, coincidentally or not, you can see that 2 out of these 5 best months have occurred within 1.5 years of 3 worst months, right? So the best months were, if you look at April 9 and May 9, were only after the worst months of January 2000, June 2008, and October 2008. So 2008, we all know the global financial crisis hit, right? And the Lehman crisis happened later part of the year. You had the first shock in Jan, then later in June, and post the Lehman crisis, it was October. And post this is where you had the best months. Now, if a investor gets panicked during this time and gets out of the market and then decides to time the market, he never got those lows, right? Because the best months were April and May later. So, what is it that I'm trying to tell you is that it is very difficult to time the market. Market lows often leads to emotional decision making, right? And we have to tame our mind to not take panic decisions, and investing for long term while managing volatility may result in better wealth creation. And it is a known thing that if you invest over a longer period of time, the volatility in a way sort. Now the challenge is, in every single crisis, right? We had almost 18 crises, let's say in the last, 20 years or 25 years, 18 times when there were, dips in the market. And every time, or every single time, I must say, except once, between when the dot-com crisis happened between 2000 to 2003, within 12 months of that crisis, or within the 12 months of the market dip, investors who stayed put have made better returns within 12 months. The other myth which you should all have is that when you look at the fund fact sheets, all the fund fact sheets say that, okay, this fund did so much returns. Now, the problem with those returns is that the fund has given that return, but the investor has never got that return, right? There is this whole gap between investor return and investment return. Now, the highlighted phase in the first graph is actually underperformance of the fund. And if you look at it, and this is a, live example of a fund, every time the fund is underperformed, right, which is the best time for the investments. If you look at the amount of money and the AUMs which have come, they've all come when the market was at the peak. When the fund was the best, when the fund was at the peak, you got more return. When the fund is underperformed or at the low, nobody invests. Because, like I said, the common investor behavior is look at the last 2 years, 3 years performance, it's done well, and then you start investing. If you look at those red graph lines there, the bulk of the AUM has come when the fund is actually at the peak. And when the fund was actually not doing well and it was low, there have been no money, which is net flows, which have come in. And therefore, that is one. Two is, the entry and exit of investors is more panic driven. And hence, the fund may have given you 18% CAGR or 19x CAGR over the longer period of time. The investor is actually made only, let's say 7% return in this case. So there is a gap of 15x, which is because of completely, like I was sharing with you, a behavioral gap. Now, one clear example, again, if you look at the journey of Nifty 50 for the last 26 years, right? It is good to say in theory that time reduces volatility, but can we demonstrate it, right? And here's a scenario, and you take any example. Let's say, for example, let's take the example of 2001, or you take 2000. So the first graph, it says year one, if the investor were to come in the year 2000, in the first year itself, he got negative 15% return. In the second year also, he got 15% return. And in the third year, he got another 10% return. And this, mind you, are CAGR returns. So 15% CAGR for the first year, same for second year, and 10% actually. So he's lost 10% money every each of the 3 years. And you look at if he stayed put in the year 4, he's actually made 6% compounded annual growth rate returns for each of the last 4 years. And that has happened across the cycle for the last so many years. If you look at the bottom table, you know, like I said, there are 26 years since the data is available in Nifty from 1995 to 2020, right? And it is very clearly says that anybody, right, who invests with a medium to long term horizon is not lost money. So let's say, for somebody who's investing for year nine, right, at any point of time, wherever you are investing, you have 18 observations in the Nifty started, and there are 18, each of the 18 observations were positive, which means that this investor who stayed put, any investor who's invested into Nifty and held it for 9 years has actually not lost money even once, right? And obviously, if he's invested for 10 years, 12 years, 15 years, he's always made money. So the point is, how can it be long term? But if you were to do in an actively managed fund, let's say I'm just another example of HDFC equity fund for 26 years. In the earlier example, you see that he makes 100% of the positive returns only if he invests for a minimum of 9 years. And here it is now come down to 5 years. So in the journey of 26 years for HDFC equity fund as an example, any investor were to invest for more than 5 years of time horizon, 100% of the times he's made money. Right? If he's invested for only 4 years, maybe 91% of the time he's made money. Out of the observations of 23 times, he's made positive returns for 22 times, 21 times. Now, the whole learning from this is that the longer you held funds in equities in particular, because equity by nature is volatile, and the premium you get is to do with the risk which you are taking. But as you hold the funds for longer period of time, the volatility reduces and you end up making better returns. This is one more example of an equity fund. And the last piece, which is the most exciting piece, is that what is the investor behavior, right? So winners keep changing. We discussed whether it's 1 year rolling returns or 3 year rolling returns, right? But this is how this is a human psychology graph. So at the start of the market, when the market is on a growth path, all of us are optimists. We're excited and thrilled when the market starts moving up. And at the peak, there is euphoria. Maximum amount of money for any fund or any market happens when the market is at the peak, right? Which actually is the point of maximum financial risk. And the euphoria really builds because you're looking at the past trend and see, oh, every time the market is only going up. And when the derailment happens, then obviously there is anxiety, denial, fear, desperation, panic. And you keep justifying yourself that, okay, this is only a, temporary setback. This will never end. And at the bottom, everybody is depressed. Oh, I am gonna lose. There is no hope for the market to go up. And most people then start redeeming at this level. And this level will also pass at some point of time, and the market then will have some hope, relief, and again the curve of optimism and onwards keeps starting. Now, if you go back to history, this is a curve which keeps happening in the markets every single time. It is just that the magnitude and the velocity of this curve will keep changing. So the investor behavior has not changed in every single pass. This is mostly for retail investors, which typically happens this way. So if you are an investor in equities, I think the clear mantra for equity investor is, and I think try to put it in this slide, that you need to have a vision to see that stock market crashes are marked by high level of noise in the near term, right? So you need to have a vision that, okay, do I want to hold it for 7 years, 10 years, 12 years? Then once you have that long-term vision, you need to have the courage to buy. Because at this point of time, let's say if everybody is fearful, do you have the courage to buy the right thing in line with your vision? And the most important is that once you had the vision and the courage to buy, do you have the patience to hold? Every time the market goes down, your portfolio returns are minus 20%, minus 40%. Do you have the vision, patience to hold? And I think this, to my knowledge, is the key. Many of us have the vision, maybe by practice, maybe by somebody counseling or somebody pushing. We also have courage because our liquidity position at times is looking good, but very few of us actually have the patience to hold on to this. And this is the key behavioral trait, that how do we have more patience, right? So, I had mentioned that I'll probably do a, half an hour, 35 minutes. So just to, markets are cyclical, right? Uh, However, what is difficult is to the length and the magnitude of markets. Asset allocation is the best solution to tight volatility because it takes into consideration the customized needs of the investor. One needs to have a proper investment charter documented for everyone. Now, what do you mean charter? Investment is just a documented need of your 4 5 parameters, which includes, okay, what sort of a behavioral trait do I have? If the market were to go 10% up, how will I behave? If the market were to go down 10%, how will I behave? And therefore, once you put those behavioral traits, your long term or medium term or short term needs, your time universe, and your risk appetite, that becomes your documented charter. What it does is basically, irrespective of the market movement, it inculcates some amount of decision making which is more disciplined than necessarily a biased one because of the changing market scenario. It also provides, like I've written, a madness in the volatile investment, right? Because nobody knows what is happening, right? And if somebody is standing up and telling you that, okay, I know where the market is going to be, he is not only bluffing you, he is bluffing himself. Invest with good quality managers, right? And it is possible that the good quality managers can also have underperformance. So underperformance does not necessarily mean the fund manager is not good. It is situational. And the most important thing is invest time in the market, which leads to long-term wealth creation. Do not try to time the market. So it's very simple, actually. And there are many behavioral traits, you can learn. There is a book called as The Art of Thinking Clearly. It really actually narrates 99 different behavioral biases, which most investors make a mistake, right, in taking the right decisions. So what I'll do is I'll actually stop here, and maybe if there are any questions, I can take some of these questions.
Yeah. Thank you so much, sir, for this clearly explaining the importance of the financial planning. So, summarizing the presentation which you have made, three things have come out clearly. Never ever try to time the market, diversify your portfolio, and stay invested for longer period of time. So there are quite a few of member participants who have raised questions. So like just before going to the participants for the questions, if may I ask you, like if we look at the debt mutual funds, they form an integral part of long-term investment strategy of a conservative investment. But considering the prevailing scenario with respect to what happened with the 6 to 7 funds in the Franklin Templeton, or what happened during the 2008 crisis with FMPs, how safe is the investors' money with the mutual funds? And second part to this question, how as investors do we look at it? And as a financial planner, how you are yourself looking at it, considering the fact that investors' confidence is also on a shaky ground? Over to you, sir.
Yeah, I think it's a excellent question, because traditionally the universe was, people who have a high risk appetite will go into equity, people who have low risk appetite will necessarily go into debt. What has happened in the last few years, particularly post ILNFS, is that the long term duration investors got impacted because interest rates move on the other side. And then later on, investors who were into FMPs, had a big challenge because they were told that if you were to hold till maturity, the investor will get the predefined, mark to maturity, the returns, if, depending on the maturity of the bond. And of late, what happened with Franklin is that, the credit risk really came to the fore. One new thing which happened in Midway was the Yes Bank 81 bonds, which people thought is a safe bond, and then they lost some money in that. So yes, there is a bit of a investor confidence which has got shattered in debt funds, over the last few years. And what has happened because of that is that the awareness level of everybody is actually gone up a bit notch higher, right? So typically what is happening is, if you look at it now globally, I mean, in UK now, UK has actually issued a negative bond, which means, by putting the money, you actually are supposed to get, so you put $100 and you get back 99 bucks, right?
Okay.
Yeah, it has happened in some of the other countries in Europe as well. In the US now, the interest rates are at rock bottom of 0.5%. In India also, the interest rates, so some of us who have seen deposit rates at 12% and 13% are actually seeing now returns going down to 4% or 5%. What you need to understand is that this is a reset which will happen. If there is somebody who's taken a loan and is not now able to service his loans, there is a reset which is happening. The premium which the investor was getting as returns is actually coming off, and that is getting passed on to the borrower who used to borrow. The home loans used to be at 12-14%. Now the home loans have come down to 7%. The personal loans have come down, and so are the business loans, right? So the reset is happening, and this will continue to have where the fixed income category will have lower returns. The question to ask is the fourth behavioral trait. What is the good night's sleep pattern for you, right? And if you do your asset allocation and say, okay, if I invest today 100 rupees with a, let's say, 5-year horizon, and if that 100 were to go to 50, I will not lose my sleep. That is the trait of investing into equities. And then you say, okay, if 100 goes to 50, there is a possibility 100 will go to 200 in the next 3 to 5 years. But I should be ready to withhold the volatility of 100 going to 50. Similarly, since you asked me specifically on debt, one needs to now reset the expectations that the debt fund returns are not going to be as high as 12-15%. They are going to be single digit lower end returns, right? It will continue to be giving you much more safer returns. The question is within the debt fund. For example, I was just looking at the data in the last 1 year. The short-term debt funds and the long-term debt funds, if you take the credit risk funds outside, have given very healthy returns of almost 10 to 12%. The one part of the category of debt fund, which is called as the credit risk funds, actually got impacted. So, what is important for an investor to know is that in equities, like there is risk, in debt, there are risks of interest rate, there is liquidity risk, and there is credit risk. So there are certain categories like, you invest in banking and, PSU funds, which are much more safer than, let's say, credit risk funds, or you invest into short-term corporate bonds or long-term corporate bonds, which are much more safer. So within that, there is enough and more to invest, which is also safe.
Okay. So just picking up from your point, just nothing related, no, just a general question. Like you spoke about the negative yield in UK. So if you invest 100 rupees, you'll get back 99 rupees. So is it a nationalistic fervor which drives the investors to put in money, or what it's exactly like?
No, it is the fear.
Okay.
Because the overall interest rates are so low that it is good to keep the money in a bank deposit, because you don't know it is happened in many other countries also. It is because the overall environment is so bad that your interest rates are actually even below 0%.
Oh, okay. Okay. So now, so moving over to the next question, like traditionally Indians have been like more of giving more importance to the investment in precious metals like gold, and have also invested into physical assets like real estate and all. So when it comes to the idea of investments in markets, either equity and debt has been a preferred choice of like a certain class of educated and financially prudent Indians. So now getting back to three questions, like three questions are embedded into this. How would you rate the risk return matrix of investment in financial markets, that is equity and the debt, and physical assets like precious metal and land? And horizon could be for say 5, 10, and 20 years. And globally, in terms of the portfolio mix, how does India stand in terms of percentage investment in financial assets vis-a-vis physical assets? And the final one is there a changing trend of investments among next generation in India as compared to the previous generations? Like
Yeah.
as a financial planning planner, are you looking at that kind of a change happening?
Yeah. So I'll first address this different asset classes.
Mhm.
Uh, India compared to globally has, or traditionally, let me put it this way, used to be skewed towards higher investment into physical assets like gold and real estate, right?
Yeah.
Small percentage of the people even today invest only into equities and mutual funds. It's just 4% of the savings. A large part of the money was always going into physical assets. Globally, the skew is on the other side. Many investors, developed countries, the investment is higher on the financial side. Now, the trend what we have been seeing in the last many years is that incrementally the share of and the financialization of savings theme is catching up in a very big way. So in fact, from 2014 onwards, the trend is actually reversing, and there is more money incrementally going into financial assets than into physical assets. So as we talk in just terms of ratio, 60 to 61% of the savings is going into financial assets, and about 39 to 40% of the savings which is going into physical assets. Now the trend is going to be, and like I shared in one of the slides, that the personal consumption expenditure has gone up and the household savings have come down. That is also primarily because uh, the money actually is not going into residential real estate, as an example. More money is going
Okay.
into financial assets, into FDs and mutual funds and so on and so forth. The mutual fund industry, if you see, is growing at a phenomenal CAGR of 22% for the last so many years, right? So every year the AUMs are only swelling there because there are more number of people who are coming in, right? It's also a very smart marketing from Amphi and everybody else. So the first, if you go back to a few years back, the first thing we all heard in television and other places was mutual funds have a market risk, past returns are not the same as future. And so it started with a disclaimer, it started with a negative connotation. Later on they very smartly realized this and they converted the whole pitch to mutual funds sahi hai.
Mm.
Suddenly the narrative changed from negative to positive, right? And that's how so the answer to the question is we're seeing a very clear trend that the financial savings is occupying a much more pie of share than necessary, and then the physical assets, and this will continue to grow even bigger as we go ahead, because while gold may grow, but investment into, now in this era where people are more scared about their jobs and business income, why would you want to leverage and invest into, let's say, a physical home? You would be happy to stay in a rental house, right? Those are the macro trends which will emerge. So that will continue to grow. That answers part of the question in terms of the global and the Indian piece of thing. And the second part of the question which you asked was what? Sorry.
It was like globally in terms of the portfolio mix, how Indians stand in terms of percentage investment in financial assets versus physical assets, and how the next generation, like if we compare the next generation with our previous generation, wherein we were more focused towards investments into the gold and all. So how that is shaping up? How are you looking at it as a financial planner? Is there a change or is it the same way it's going on?
So there is a very big change actually the way we are seeing. Traditionally, the elder generation used to slog all their lifetime to buy a home which they can retire and safely stay in and take loans and pay loans, through the lifetime. I must say, this is the traditional investor behavior. The younger generation and the millennials, do not believe in owning assets. So they do not want to wait for, let's say, another 30, 40 years and own an asset. They want to own an asset today. So if somebody is in the first year or the second year of a job, he doesn't want to wait for another few many years to stay in a good, he's happy to spend money and on rent, buy gadgets, whether it's a smart TV, flat TV, whatever it is, best of the audio equipment, stay in a much better palatial house and spend the money today. And if he doesn't have money, he's happy to borrow today. So leverage has become bigger, right? People are wanting to borrow more and spend today. And as far as investment behavior is concerned, I think the big change is that the risk appetite today at the younger age is much higher than it was, let's say, 10 years back. Two, I think the digital adoption by this younger generation is so much higher. So, with or without advice, they're also using some of the tech platforms to do these investments. Now, it has its own pluses and minuses because investing through a technology media is so easy nowadays. Like you buy,
Right.
anything on Amazon or Flipkart with the same click of mouse, you can actually invest in any of the funds today in any of these robo advisory or platforms. The question is, we have about almost 8,500 crores of SIPs going. Many of the investors who start on their own, 40% of them are actually, because it is not a good advice given, they're doing it, ad hoc. 40% of these SIPs stop within 6 months. Or in this period of crisis, then they start liquidating. But I think the trend is clear that there is a higher risk appetite and there is a digital adoption.
Okay. So now on the health insurance part, like we Indians, like whenever we go out and purchase a car, we always look at, there was also a tagline, kitna deti hai in case of Maruti. Similarly, in financial assets also, we try to invest in such instruments wherein we actually look at kitna taka milega mujhe ispe. So on those lines, working on those lines, we normally tend to ignore the purchase of the health insurance plan, or for that matter, the life insurance plan. And but the current crisis has strengthened the relevance of owning such plan. So as a financial planner, are you looking at any uptake in purchase of such plans, and what should be the criteria for purchasing them?
So when in 2000, if you know what happened with the IT industry, 31st December, I was working for a bank, and middle of the night, being 3 months old in the bank, I was one of the younger ones asked to stay put and say, okay, celebrate your 31st December New Year night in the bank, because we didn't know what will happen after 12 o'clock. We were given satellite mobile phones, so that if the network were to go for a toss, and 1st January morning, if a client wants to do transaction, if all database goes for a toss, everything was stored in a digital format. And if let's say the electricity were to go and the telephones were not to be operated, then we can communicate on satellite phone across the globe. You know. So what followed after that for a decade was a humongous IT innovation, because of the crisis which we went through. This crisis today is the Y2K moment for the healthcare industry. A lot is going to change on two fronts. One is on the research side and the manufacturing of the pharma side. A lot more innovation will happen. We probably will now anticipate that many more, COVID viruses or coronaviruses will keep coming, and how do we then preempt that and keep ourselves, ready and immune? So there will be a lot more innovation which will happen. Second is a behavioral change. How many times in the past you and me would have gone down our buildings and come up and washed our hands 4 times or 5 times a day, right?
Right.
How many times we would have gone and purchased sanitizer? Sanitizer was like a alien term for all of us. Now, whether it
Absolutely.
is slums in Dharavi or whether it is high-rise building in Bombay, everybody is using. I used to work in Singapore, and I used to think that wearing mask is such a funny thing if you have a small cold. Now, all of us will ensure that if the other person is sneezing, you will gift a mask to him. Right. So these are
Right.
behavioral changes because it's a once in a lifetime crisis. And I think this crisis will bring a lot more change in the way we look at it. So I think a lot of it is going to change.
Okay. So as you yourself spoke about that, there is going to be a lot of change.
Just to share with you, a trend which we are seeing is that many clients, many investors who were ignorant about, let's say, health insurance or life insurance, are now suddenly saying that, okay, if I were to forget COVID, if I were to get any other disease, if I were to go to a hospital today, the cost is going to be exorbitant. So, if I have a cover of 5 lakhs, can I make a family floater of 20 lakhs? So that trend is already started. In the developed markets, insurance is mandatory. Like in India, we are used to say that, okay, you do a car insurance, and if the accident doesn't happen, you don't get the money back. मुझे कितना पैसा मिलेगा, कितना टका रिटर्न मिलेगा, ये थोड़ा थोड़ा धीरे धीरे पीपल विल रियलाइज कि वो प्रीमियम देना बेटर है rather than it's a 1 year 2 year premium is better off than really going to the hospital. So do you, after paying the premium, are you happy not to go to the hospital, or are you happy to recover that premium you want to go to the hospital? That's the question.
Question. Right. Okay, so so basically in this scenario wherein you are seeing salary cuts happening across the board, businesses not making money, so how do you how do you want the people to manage their investments during this uncertain time?
I think
Your take on this.
The most important thing for anybody, whether it's a salaried employee or a businessman, I think the most important thing is for the next 6 to 12 months, one should be sitting on cash of any contingency which might come, right? Because as a businessman, you have many other obligations, payment salaries to your employees and so on and so forth, and business income. So 6 to 12 months of running expenses, one should keep aside in cash. And so is the case with, salaried employee. Because unless you have 6 to 12 months of provision kept aside, this uncertainty looming large will not then equip you mentally to be ready for it. So first, that is what I would recommend everybody to do it. And the second is use this crisis to really think through what sort of appetite you have. Earlier, you were having maybe equity as a appetite because everybody else was investing, and with the slightest drop of 10%, now you're losing a night's sleep. The reverse is also true, that you always felt that I want to be safer onto debt side, but today is an exciting opportunity of investing into equities. 3 years, 5 years later, if you want to go back and see, you would probably repent that one could not take the best in terms of. So I think I would recommend everybody to do the investment charter, set up an asset allocation today, and then stick to it with rebalancing over a longer period, over the on an annual basis.
Right. Thank you so much, sir. Actually, we are just running out of time. I would request Ms. Anuradha Salwan to actually just give closing remarks, please.
Thank you, Deepak. Thank you, Virendra. I think it was one of the most enlightening sessions. It's been a while since I've heard a discourse of this nature. Personally, if anybody was to ask me, I wish I had attended such a thing, or 10 years ago. I would have been in place today. Many old things that we've heard of, but during a course of life you tend to forget about them, what timing the market and all that, and how historical returns don't really reflect what the future of the fund is going to look like, and how prudence is required. But then again, that thin line between a normal, common Indian investor and a well-educated, well-informed investor will always, I guess, remain. That would be, I believe, and from CII, we also believe that financial literacy and awareness is one thing that we need to work on. We're doing a lot of things on that. And I think markets should be also one of the things that we should start educating the general class about, because while we're talking about it, and we have so many attendees today who understood the subject, but we have so many of us who really don't understand the subject. So that gives us one, and I'm sure Deepak and I are going to work on this one now. And thank you, Virendra. Thank you very much. It was very enlightening, and it was like going back some historical days when we used to attend some classes on financial planning. Thank you.
Thank you so much.
Yeah, thank you so much. A pleasure.
Yeah.
Thank you all participants. Thank you for joining us. Thank you so much.
Thank you, participants. Thanks a lot.